working career as president of two different 1031 companies that were owned by title insurance companies. But I'm currently the general manager of National 1031 Exchange Services. And I have spent 5 years as a capital gains tax strategist working with multiple tax strategies besides the 1031 exchange. Scott Varney, who you just saw, he is also a capital gains tax strategist, and Scott is licensed for real estate in Texas since 1996, and he was in real estate a top 0.2% producer nationally. He closed up to 61 real estate clients per year, but currently he lives in California and he is in financial services. So he does life and long-term care insurance and annuities. So this presentation includes financial discussions and is not to be construed as financial advice and not to be considered legal advice. Please note in this discussion we use the word save, which refers to the financial and tax implications within a given year and more accurately refers to tax deferral in perpetuity pursuant to Internal Revenue Code section 643. For formal tax advice, we recommend you seek the services of a duly licensed professional. If you don't have one, we have two different people that we can refer you to that can help you with all of the strategies that we're talking about. So the first strategy, we're going to talk about how to defer taxes for 30 years. So that's called a monetized installment sale. It's based on Internal Revenue Code section 453 and 453A. So the foundation for the tax side of the installment sale tax planning approach, section 453 of the Internal Revenue Code, has been around since 1913. That section, the installment sale reporting section of the code, declares the general principle that when a taxpayer sells a capital asset and does not receive full payment of the selling price in the year of the sale, the transaction is an installment sale for which the seller owes the tax pro rata as and when the principal is received. And then in 1980, Congress said a seller could receive loan proceeds in connection with the installment sale contract and still receive tax deferral. So the whole concept of this strategy is when you receive principal, and we're going to walk you through it because you're not going to receive principal for 30 years. That's why the tax bill's not due for 30 years. So the Office of the Chief Counsel of the Internal Revenue Service issued this memorandum supporting this type of transaction, and it was issued back in August of 2012. And that memorandum said that this was good for the client and good for the economy. So let's walk you through how this works. A monetized installment sale. So if you have a seller who that wants to sell property, could be real estate or a business, privately held stock, art, antique collection, or cryptocurrency. The seller's agent finds them a buyer. They enter into a contract under the terms agreed by both parties, just like a normal transaction. Then you open escrow with the local title company or the attorney's office. The seller sells their asset to the capital asset dealer. Now, the capital asset dealer is another form of an intermediary on a long-term installment sale contract with interest-only payments, typically for 30 years, with a final balloon payment of principal. The seller receives the installment sale contract and a promissory note from the dealer. The dealer immediately resells the asset to the originally intended end buyer for the same price and terms originally agreed upon by the seller and the buyer. The buyer's cash goes into escrow. The buyer takes possession of the property and exits the picture. So the dealer will have introduced the seller to the lender. He's a third-party lender who's not involved with the installment sale transaction. The lender provides the cash to the seller in the form of an unsecured limited recourse loan with some seller protections included. The seller agrees to pay the lender interest-only monthly payments for 30 years, with a final balloon payment of the principal balance, typically 95% of the seller's net sales proceeds with some fees to pay. After closing, the dealer's payments to the seller are automatically passed through these long-term escrow accounts, which then automatically forwards the payment in the same amount to the lender on behalf of the seller, who is technically now a borrower. The dealer's payments fully fund the seller's payments to the lender, including all the monthly payments of interest and the final balloon payment at the end of 30 years. So all you're left with in this transaction 30 years from now, you or your heirs, is paying what you deferred on day one, which was your capital gains taxes. And you have had the massive benefit of inflation and the time value of money working on your behalf. So at this point, I'm going to let Scott talk about the value of the monetized installment sale.
All right. So I'll share my screen. All right, the value of the monetized installment sale. First of all, it's the flexibility that people need. So when the funds come to a seller that's using a monetized installment sale, those funds are coming in a form of a loan, and it's an investment business loan. And because of this, there's a lot more flexibility. You do not have to replace with like-kind property of equal or greater value. You can actually take those funds and put them into any kind of business. This includes taking the gains of a highly appreciated asset and paying off loans on other investment properties, which a lot of our clients like to do that because they would like to reduce their debt load. They also could start a restaurant with those funds, or a Mary Kay business, or whatever it is. As long as it goes to business use, it counts. Or they could put it into a financial vehicle like stocks, bonds, mutual funds, life insurance. We have a lot of clients that we talk to that are trying to get away from dealing with tenants and toilets. They want to retire and not have to deal with any investment properties anymore. And this gives them the flexibility to put their funds into investments and enjoy retirement. Get this here. All right. It also provides a great exit strategy. Like I said, clients do not want to deal with tenants and toilets anymore. They would like to retire. They don't want to get those calls that a water heater just burst and the water has just destroyed a lot of stuff in the garage that is owned by the tenants, and the tenants are really mad. Those kind of things happen, and they don't want to get those calls anymore. They would just like to know, hey, my money's over there growing. I'm going to use collect the interest every year to help pay for my retirement. So clients that use this strategy have options, which is a key. They no longer want to deal with the 45 or 180-day requirements that come with a 1031 exchange. As a matter of fact, 1031 exchanges often fail because an investor cannot find an investment property that they are comfortable with buying, or they are competing with other investors who are in the same race to find a property, and the investor loses out. And you look at history, right now we are trending towards the 60% failure rate for 1031 exchanges. Typically in the market, you'll see 40% failure rate. Now we're trending more towards maybe 60%. And that's a problem because if your exchange fails, then you're going to be paying the taxes the next year. In this case, you could sell your property and sit on the funds as long as you want until you find the right fit. You don't have to identify in 45 days. You can identify in a year and 45 days if you want to. You wait, you take the time, find the right market, find the right fit, and then you purchase. And that is a great opportunity. But if you follow these restrictions, then you could end up failing. And the next year, Uncle Sam, who is not your uncle, will collect those taxes. All right, rescuing a failing exchange. So many people do set up a 1031 exchange. And if they do not find properties that in that 45 days to identify a property, they have a failing exchange. Or if they did identify a property, and let's say you're at day 50 and the inspections are done, and you find that there is a major problem with the property and you don't want to buy it, or the seller's not willing to cooperate in getting things in repair, that could cause a failure, or maybe the house burns down before, and that's happened. Ruth is given that as an example. Or you're in the hospital and you can't sign the docs in time. There's all kinds of reasons why exchanges fail. And if they fail, you're going to be paying the capital gains taxes, the depreciation recapture taxes, and debt over basis taxes, if there are some, in the next year. Now, one thing to understand is a lot of people actually don't do the depreciation. They just, maybe whether it's ignorance or laziness or whatever it is, they don't depreciate. Well, even if you don't depreciate, the government is going to have you pay back 25% of what you should have paid or should have depreciated over that time. So those taxes really, really add up. And by the way, not all exchange accommodators cooperate with capital asset dealers by releasing the funds to another strategy. If the 1031 exchange accommodator or intermediary, depending on what you typically call them, qualified intermediary, if they don't cooperate with installment sale agreements, you're stuck paying the tax. But if you have an exchange accommodator that does cooperate, like Ruth, then if everything seems to be on track to fail, then you can rescue it, defer the taxes for 30 years, and not have to worry about that problem. All right, no replacement loan required. See, if you have investment properties and you sell one and there's debt, let's say there's a $300,000 debt on the property you're selling, you have to replace that debt with debt of equal or greater value. So you have to get a loan for 300,000 or more, or you have what's called mortgage boot, and you will have to pay taxes. Now, that could be a problem. One, you could be like one person I talked to who, when they went to apply for a loan, found out that they had a house foreclosed on them, and they're like, where did that come from? Well, somebody got access to their social security number in Southern California, bought a home using their social security number, and then defaulted on that loan eventually, and it was foreclosed. And this was all without this person knowing. And so those kind of stories happen. Or maybe your debts or your credit score is not as good as you think. So if you do qualify for a loan, maybe you have to pay a higher interest rate than you thought you were going to have to. So this can be a problem. And with the monetized installment sale, the monetized part of the installment sale is actually the replacement loan. So you do not have to go get another loan. So if you sell property for $2 million and maybe you had a $500,000 debt load on that, you have $1.5 million minus closing costs and whatnot, you could actually just go buy a replacement property or properties for what cash you have, and you do not have to replace that debt. It's a great option for you. All right, increased depreciation. So in this example, let's say you bought a property for $250,000, you owned it for 15 years. It's now worth $1.2 million because, of course, you bought in California at the right time. Now you decide to sell at $1.2 million and purchase a new property, let's say at $1.8 million. In this example, if you do a 1031 exchange, you're going to have $499,000 of depreciation available moving forward. If you do a monetized installment sale, using the same example, you have 1.259 million of depreciation available. So basically you have about $750,000 more that you can depreciate and leverage the tax savings on that to do other things with your assets. So that's a significant value in regards to depreciation. Numbers, goals, and personality. So when we talk to prospective clients, we want to make sure the numbers fit. The cost of the strategy, again, is 6.7%. If the tax bill is 100,000 and the strategy is 84,000, that's not a good fit. Every tax strategy has a cost and a commitment. And we want to make sure that everything is a good fit. So we have to look at the numbers. We have to look at the goals. Monetized installment sales very seldom fit on a sale of a primary residence because people sell their primary residence wanting to go buy another primary residence. Well, by doing so, you could end up incurring an annual tax bill, income tax bill, by using the funds for that. And so we have a 30-minute video that actually walks through that. And then personality, you have to do the reporting for 30 years. And so, oh, sorry about that. Forgot to mute. All right. So the personality can be an issue. And so if they don't want to deal with the reporting every year, then it's not a good fit. All right, so a little bit about the timing and the process. Again, we have a 30-minute video that gets into the mechanics of the strategy a little bit more. And then once you've gone through that, we have documents on our website that you can pull. Reach out to us and we'll go over your numbers and goals to make sure the strategy is a good fit for you. And maybe it's a different strategy that's a better fit. You talk to your tax professional about the strategy. We want you to get your tax professionals giving you counsel. We're not going to give you legal counsel on this. We're going to explain it to you, and we want your tax professionals to be there for you to give you advice. You list your property with your agent, real estate agent, and when your property goes under contract with a buyer, you set it up as a 1031 exchange. That makes it easier for the 1031, for the title companies to close it. They understand how to close 1031 exchanges a whole lot better than they do with monetized installment sales. So this makes it a much more simple process. You reach out to us to get this strategy started. So what's going to happen is that you'll set up the 1031 exchange with National 1031 Exchange Services. That way it can more easily flow into the monetized installment sale. Ruth will send you a letter of intent that is from a capital asset dealer, and that will that way, once the seller signs that letter of intent, the documents will be released for review. This is not going to be released a day before closing unless you call us a day before closing. We want you to have time to review the documents, to have your tax professionals review the documents to give you any kind of counsel that is necessary. Once that's signed, documents are sent over, then the seller signs the documents. Once they are signed and the transaction is closed, the seller will get all of their funds within 5 days of the close of escrow. And the reason why it's 5 days is because we don't know the exact penny that's going to be released until the final HUD-1 statement is signed, because that could be changed at closing. So once the buyer and the seller sign off on the HUD-1 statement, if there's a lender involved, they approve of the signed documents, then the whole process kicks into high gear, because now we have the exact penny that needs to be done with the strategy. And then you contact your tax professional with all closing documents for the next year reporting. All right. I like to call it as easy as 1, 2, 3 strategy. You set up your exchange with an accommodator that will cooperate with a monetized installment sale. We get calls all the time. My exchange is going to fail. Can you help me? And the answer is maybe. So who is your accommodator? Oh, it's IPX. Well, I'm sorry. No, they will not allow you to rescue your failing exchange. Or maybe it's Ralph Bungie in San Francisco. Oh, awesome. He loves this. He will allow you to rescue the exchange. So you have to make sure that they're set up for success to begin with. So talk to Ruth, and there are other exchange accommodators out there. If you have a favorite one, let us talk to them and we'll let you know if they will allow you to rescue the exchange. Then look for the 3 replacement properties. We also suggest you designate a Delaware statutory trust as a replacement property or as a backup if you're trying to keep your funds in real estate with the passive income. So that could be an option as well as part of the 45-day identification process. And if nothing looks good, or you have a problem purchasing the property you did identify, then we can move it into the monetized installment sale, defer the taxes for 30 years. Now you have more flexibility. So you want to be set up for success. If your accommodator will not cooperate, you're set up for failure 4 to 6 times out of 10. Those are not good odds. So again, all of this hinges on the right kind of 1031 exchange accommodator to begin with. Strategy number 2 is to defer your taxes for generations. Now, we can guarantee that it will defer the federal capital gains taxes. State to state, there's a level of aggressiveness towards getting taxes from trusts. So we, in California, it may be able to defer the capital gains taxes, but we don't guarantee that because the state may be aggressive enough to go after that. So we always tell people, let's look at the numbers. If they do collect the state taxes, is it still a good fit? All right, so in this part of the presentation, we're going to go over the problems that we face. Basically, I'm going to tell you the bad news. If you're familiar with Winnie the Pooh, you'll remember Eeyore. We have problems. And then there's Tigger in Winnie the Pooh, the bouncy, trouncy, fun, all the good news. And that would be Ruth. Ruth is our good news presenter this morning. And so she will go over the technical overview and break it down into simple terms, because the technical over the head kind of information. So how does it practically apply? And then we'll go over the process. So problem number one is capital gains taxes. And especially here in California, we rarely see anybody that's lower than a 20% tax bracket for the federal. Plus you have the net investment income tax known as Obamacare. That's 23.8% right there. And then depending on the state, California, that's 13.3%. That's a total of 37.1% that goes to taxes. That doesn't even include depreciation recapture and debt over basis taxes. So people often are paying over 50% in taxes. That's a significant tax bill, especially for those who want to sell and have some flexibility. That could be a problem. As a practical example, let's say after closing cost of an asset sale, there's $1 million. Let's say the basis, that's what you paid for the property, is $250,000. You have $100,000 in improvements, so the gain is $650,000. The federal part of the taxes, including Obamacare, is $154,700. That's a significant tax bill, plus state tax, plus depreciation recapture tax, plus potential debt over basis tax. You could be upwards $250,000, $300,000 before you know it. And that's a big bill to pay to have flexibility for the assets. By the way, as a reminder, if you're not depreciating your property, you're still going to have to pay 25% back on the depreciation that you should have taken during that time. Problem number two, 1031 exchanges. Many people love 1031 exchanges. I think they've been a great and helpful tax vehicle along the way. But there are problems that do come. And as a way of review, that 45-day and 180-day requirements can be a problem. It can provide a lot of stress, especially once you're at day 40 and you still haven't found a property that you want to buy. Or you're at day 43 and you did find a property and you're competing against 10 other buyers, and then you don't get it. Or you find out, or again, the house burns down, or whatever happens, a flood, and everything falls apart. There's a lot of stress that comes with that. And again, 4 to 6 out of 10 exchanges fail, depending on the market. We're heading toward the 60% rate. Most 1031 exchange accommodators will not allow you to rescue a failing exchange. That's a problem if you are set up in the 1031 exchange system. And if the exchange fails, the tax bill cometh due. So Uncle Sam's not going to be cheap when you go pay that tax. Income taxes, problem number three. Many of the investors we talk to, they make a great income with their full-time jobs. That's how they can even afford to buy investment properties. Therefore, the rental income is often taxed at a higher tax bracket, which significantly impacts the return on investment. However, investors counter much of the tax bill with depreciation, which is a great strategy, but often they do not realize that that depreciation is a tax deferral strategy and not a tax elimination strategy. When I started, when I bought my Dodge Durango in 2001, my accountant was explaining to me that I got to depreciate my vehicle, but those taxes would have to be paid back unless I did this and this and this. And I had not a clue what he was talking about. Bottom line is, I was deferring the tax bill. And if I didn't do certain things correctly, I would have to pay that back. And so same thing with real estate. You have to pay that back when you decide to exit from real estate. Future laws. Well, 1031 exchanges, again, they have value, but 1031 exchanges are continually proposed to be eliminated as a tax strategy. And as an example, if you go to the Tax Foundation website, they will tell you, I read it in April, and they said, okay, what we have now as our current incoming administration, they are expecting to try to eliminate 1031 exchanges. Gone, boom, no value. I mean, the incoming President-elect Biden said, I want to get rid of 1031 exchanges. Laws change. That could be a problem. He also said, I want to get rid of step up in basis. And that it's not a new thing to try to eliminate. Others have tried to eliminate before, but because our debt continues to grow, the US debt, they have to find the funds elsewhere, somewhere. And where are they going to go at after that? Investment properties, real estate, those who have high net worth. You know, it's kind of funny here in the Bay Area when people go, I don't have a whole lot. Well, they own 4 investment properties worth about $6 million, and they say they don't have a whole lot. Where I come from in Texas, you're filthy rich. But here in the Bay Area, you know, it's compared to those who have 10 properties. But when it comes to the taxes, people will consider those who have 1, 2, 3 investment properties, 4 investment properties in the Bay Area as the wealthy that they're going to try and get taxes from. So it's all about perspective. And step up in basis, a lot of people say, I'm going to hold on to my properties and I will pass that on and have step up in basis. And my kids, when they sell, they won't have taxes if they sell immediately. What that means is if you paid $250 for your property and it's worth $1 million when you pass away, now instead of them having a basis of $250,000 to have to pay gains on, it's a step up to the value of when you pass away, the $1 million. Now, if they sell immediately, there's going to be little to no taxes, unless there's a death tax because it's a large estate. That that helps. But again, the incoming administration has already announced we want to get rid of stepped up in basis. Also, if you have gains over $1 million, they have said we want to charge 39.6% on any gains over $1 million. So more the income tax rate instead of capital gains rate. So they have to get the money somewhere, and that's a problem. Those are big tax bills. You know, too many investors are relying on these tax benefits for the transferring of their assets, their wealth, and minimizing the capital gains tax bills. While those laws stay in force, it's a great strategy, but if they're eliminated and that's how you plan, there's going to be trouble, a big tax bill. And that doesn't even address the death tax. Right now, per spouse, the exemption on death tax is $11.58 million per spouse. So if you have $23 million of real estate or investments and whatnot, that is exempted from the death tax. In 2025, that's going to roll back with the sunset clause to $5 million per spouse, plus adjusted for inflation, we're figuring about $6 million per spouse. So if you have over $12 million in your estate, when you pass away, the beneficiaries are going to pay between 40 and 50% on the death tax. Problem number 5, personal and business liabilities. Well, lawsuits abound. You know, if you have a house, we could be sued if someone trips over something in our yard and breaks their wrist or breaks their ankle or breaks their leg, even if they're trespassing. If we drive, you know, the one thing about COVID is I went from about 20,000 miles a year to about maybe maybe 2,000 miles a year. So that reduced that risk. But every time we get on the road, if we are at fault in an accident, we're at risk of being sued. If you have a business, doesn't matter what kind of business, you're at risk of being sued. Property owners are liable for all injuries incurred due to hazards associated with their property, whether a home or a business. And I'll tell you, a lot of times we just don't know better. We're just ignorant. That doesn't mean we're stupid. We're just ignorant. We don't know. Somebody told me if I put up beware of dog signs on my fence, that if somebody decides to jump the fence and gets bit by my dog, I'm free from liability. Well, they were wrong. I didn't know any better, but I did. I put up those beware of dog signs. I also had a dog door. I had 2 German Shepherds. I knew that if somebody decided to jump the fence and crawl through that dog door, they're going to meet face to face with 2 German Shepherds. It was not going to be a pretty sight. I thought, okay, we're okay. Well, come to learn that if they jump the fence and break their leg, I could be sued, even if they're a criminal. If they crawl through the dog door and my dogs protected our house, I could be sued because that's how it works. They're on my property. Doesn't matter if they were committing a criminal act. And so they could take everything. That's pretty sad when the criminal can take everything because they're committing a crime and got hurt. All right, slip and falls annually are the #1 most important or common personal injury lawsuit. Since 1980, personal injury lawsuits have increased by 30%, and about 25,000 people a day are, quote, victims to slip and falls. So don't become a statistic. Basically, there's a 1 in 3 chance of getting sued, according to the IFG services, which means that, that's pretty high chance of getting sued. We are basically vulnerable to lawsuits. 2 out of 3 surgeons get sued, according to the American Medical Association. There's about 110,000 lawsuits filed every day in the US. Very litigious society. The average business lawsuit costs $72,500. And currently the US has over 91,000 personal injury lawyers. We like to call them ambulance chasers. They're always looking, trying to find those injuries. And those attorneys get paid 30 to 40% of the award. If there's a $2 million award, they're going to get paid $600,000 to $800,000. They get paid well. All right. Corporations and LLCs do not protect you as well as you think. It's easy to pierce the corporate veil because they're tightly held entities. Basically, you're operating under your alter ego, according to the courts. The courts claim that you are controlling the owner of the entity. That means that it's a winnable argument with a judge that you are the one in control of the LLC, so therefore they can come after you and your assets. Piercing the corporate veil, roughly 50% of the entities can be pierced because they're not operating their business properly. This is a reminder for all of us. I have an S corporation. Make sure we have our meetings and our records and our minutes. If those were pulled into court and you don't keep up with the laws according to all of those requirements, that's an easy way to pierce the corporate veil. And the trust we're going to talk about, once that is set up, you don't have to deal with those meetings and minutes and records, those types of records anymore. All right, state courts, 39% of the cases are pierced. Federal courts, 41% of the cases are pierced. Basically, it's not a preferable way to hold properties. A lot of people think I'm safe, I'm protected, my assets are protected. Well, 4 times out of 10, do you really feel protected? Those are bad odds. All right, a trust is not a person. In all states, entities like C Corps, S Corps, LLCs are recognized as the equivalent of a person. So in all courts, lawsuits can be filed against people or the legal equivalent of a person. So our trust is a contract. This follows contract law. It's a different type of law and is not recognized as a person. Therefore, a specialized trust cannot be sued. Problem number 7, insurance is only a partial solution, not the solution. You need to call your insurance agent. if you have an umbrella policy, ask them, does my umbrella policy cover punitive damages? If you're here in California, the answer is likely to be no. And what does that mean? That means if they find that you are at fault with gross negligence, then a big portion of the award is going to be considered punitive damages, and the insurance is not going to cover that. So basically, it's only going to cover a smaller portion of the award. That's a problem. I mean, it's still important to have insurance, but you may not be covered the way you think you are. All right, problem number 8, filial responsibility statutes. 30 states, you can see all the states here. Those of us in California, this is one of the states. And I am in the financial services business. And when I learned this was pretty fascinating and scary because I deal with this with the long-term care insurance and whatnot. Filial responsibility statutes allow long-term care facilities to seize the assets of adult children to cover unpaid bills of their parents. So if you have parents that are in long-term care facilities and they run out of money and they're still there and the bills are coming in, and that could be upwards now of $25,000 to $30,000 a month, depending on the level of skilled care they need, if it's in a dementia unit or whatnot. If they don't pay those bills, they look to the children. If the children do not have the funds to pay the bills, then the facility can seize the assets of those children to pay those bills. That's a lot of exposure. Problem number 9 is all the other problems that we did not mention. And so I'm going to stop being the bearer of bad news and stop sharing so that Ruth can take over and give us the good news. All right, Ruth, your turn.
Okay, we're going to talk about the solution. So let's break it down a little bit. I can get my computer to connect with me. There we go. So what is it? What is this that Scott is talking about? It is a trust. It is a non-grantor, irrevocable, complex, discretionary, spendthrift trust that is not self-settled. It is like a dynasty trust. It's a type of dynasty trust. So this trust has 58 copyrights. It is a contract between the grantor, the trustee, and the beneficiaries. It was designed by a collaboration of tax attorneys, CPAs, trust attorneys, contract attorneys. It took over 12 years to perfect this document. It's kind of your rule book now on how to handle your assets when you put your properties into the trust. It's been around since 1996 and it's been copyrighted since 1999. It's based on IRS code 643A3 and 643B. The primary purpose of this trust is both tax reduction and asset protection. So let's go through the parts of the trust. The irrevocable portion of the trust. So an irrevocable trust is one that by terms cannot be revoked. This is very different than a revocable trust, which allows a grantor to revoke the trust, at which time the assets revert to the grantor. The assets transferred to the trust may never revert to the one who is transacting the sale, the settlor, or the creator of the trust. So basically, what separates the settlor or creator from the corpus of the trust. So let's break this down a little bit. The corpus of the trust is simply the checking account for the trust. Now, when it says it's in an irrevocable trust, it can be changed by the stroke of a pen. Now, the settlor is somebody that you would designate as your settlor to the trust, somebody that would never have benefit to your trust, somebody that would never be a beneficiary, somebody that would never get any money from your trust. That is a settlor. So you can designate your settlor, or the company has one that they can create the EIN number to set up your trust. The discretionary portion of the trust, so a discretionary trust is a trust that has been set up for the benefit of one or more beneficiaries. The trustee is given full discretion as to when to make distributions to the beneficiaries, what to distribute to the beneficiaries, and how to conduct the business of the trust organization. This portion ensures the absolute and sole discretionary power of the trustee in determining the distribution of income and or principal to the corpus, the checking account, and or to the beneficiaries of the trust. So this portion of the trust is what eliminates capital gains taxes, and provisions address income tax issues, and it helps mitigate income taxes paid by the self-employed. Now, the complex portion of this trust, so to understand a complex trust, you must first understand a simple trust. A simple trust is one that may distribute all income earned by the assets in the trust in the current tax year. This creates a taxable event to the party or persons receiving that income. A complex trust, on the other hand, can legally accumulate income derived from the assets of the trust on an ongoing basis, adding the income to the corpus of the trust rather than distributing the income each year. When a complex trust accumulates income and adds it to the corpus of the trust, the checking account, no taxable event occurs. Rather, the complex trust is able to defer any taxes due on the income until such time the trust distributes from the corpus of the trust. So this trust alternates between simple or complex depending on the circumstances. So this complex portion also eliminates the capital gains taxes, and provisions address income tax issues, and it helps mitigate income taxes paid by the self-employed. So the non-grantor, in case of the non-grantor trust, a third-party trust called a settlor establishes a trust and appoints a person who owns assets as either the trustee or the compliance overseer, or both. The settlor must be a neutral third party and cannot later play a role as either a trustee or a beneficiary. The settlor or some other third party files for the EIN number, and the settlor's role is complete. At this point, the trustee has complete management and control of the trust and begins the process of conveying assets to the trust. The asset held in the trust are called the corpus of the trust. So that gives you the ironclad asset provision. The spendthrift provision. So likewise, a spendthrift trust that is created for the benefit of one or more persons, the beneficiaries. Provisions allow an independent trustee full authority to make decisions as to how the trust corpus may be used for the benefit of the beneficiaries. The critical element of the document is that no spendthrift trust corpus may be penetrated to reach the assets of the corpus. So this provides the iron asset protection and provides the tax benefits. So as these definitions suggest, this unique type of trust is designed to protect assets and to defer, reduce, or lessen taxes. It also eliminates liability and provides for beneficiaries without legally affecting the corpus of the trust. So the corpus of the spendthrift trust is not subject to turnover orders by any court or judge, whether federal, state, or local. And remember, the corpus of the trust is the checking account. So we have some case rulings supporting the spendthrift provision. Edison versus McLogan ruled that persons may adopt any lawful means for lessening of the burden of income taxes. And in Weeks versus Sibley, the courts ruled that a spendthrift trust organization is not illegal, even if it's formed for the express purposes of reducing or deferring taxes. We do have a private letter ruling that supports this type of trust, but let's break it down in simple terms. This trust defers taxes for generations. Federal, as Scott said before, federal taxes, absolutely. State taxes depends on the state. In the state of California, California is getting aggressive. So we don't want to promote that California won't take their tax. Currently they have not, but we see it coming. So we want you to be aware that state taxes could be due. So how exactly does it work? When you buy and sell properties from your trust, your federal capital gains are eliminated as they convert to extraordinary dividends. And the taxes in extraordinary dividends that are passive are then deferred in perpetuity. So a trust needs to have an ending date to be valid. Remember, this is like a dynasty trust. So this trust will end 21 years after the death of the last heir from when the trust was created. Now, I have a 1-year-old grandson. He is my last beneficiary. So what's going to happen, he's the last beneficiary in my trust. So what's going to happen is my grandson, when the last heir dies of his, okay, so when he has children, when that last person passes away, it's 21 years after that date if nobody decides to renew. So you're going to have an option to renew your trust every 21 years. There's no cost to renew. It's simply a form that you're going to sign to renew the trust. So this trust goes 10, 20, 30 generations, hundreds of years down the road, okay? So this trust will be taxed either when the trustee decides not to renew it or 21 years after the last heir to the last beneficiary has passed away. So this trust is such an amazing tool that you create it today, and your great grandchildren get to use this benefit. They get to use this trust for their benefit. So, you know, they're going to be thanking you when you're in your grave. They're still going to be thanking you for what you gave them. So our roots of the trust come from the dynasty trust. So the Rockefellers and the Kennedys have this type of protection. It's an ultimate tax deferral vehicle. It's based on IRS Section 643, with that states the trustee has sole and absolute authority to designate income as extraordinary dividends or taxable stock dividends, and that is paid to the corpus of the trust and not subject to distribution. It is not income to the trust according to IRS Code 643. So what's going to happen is you are going to buy and sell assets within the trust. So you are going to sell your assets to the trust. You're not going to be gifting them. So you can sell your real estate, your business, stocks and bond trading, Bitcoin, cryptocurrency. You can sell your assets to another trust. There's no federal or state probate and no gift tax. So zero federal capital gains on the growth or sale of any trust-owned assets. The sale of assets are to the trust are non-taxable events because you are selling at basis. So you're selling it at the price you bought it for. So there's no gains there. So unlimited amounts of assets can be sold. So if you're a person that has multiple properties and you set up an LLC for each property, so if somebody sued you, they can only take that one property from you. That's a great strategy. That's what we knew for so many years. But now, if you set up your trust, you don't need all those LLCs. You don't need to pay the annual fees to keep those LLCs and file a tax return on all those LLCs. You put everything into your one trust. So the trust eliminates the need for 1031 exchanges. The trust now sells the asset. The sales proceeds go to the trust. There are no restriction as to how and when those funds are used. You can choose to invest outside of real estate if you want to, or you can buy real estate, but when you find the right fit and not deal with the 45 days, 180-day timelines. You know, I don't have the magic ball, but I feel next year is going to be a good time to buy real estate. So passive income is defined like your rental and lease income from your property or business. Stocks, future sales of your properties are now paid to your trust. So zero capital gains due when the property or business is sold. And on your income tax bill, you can reduce on passive income 78 to 97% of your income tax bill, which then the taxes are deferred in perpetuity. Now the trust can mitigate active income taxes paid by those who are self-employed. So this doesn't help anybody that's a W-2 employee unless you have a side business. So if you have active business, you want to set up a second trust that takes care of the active income. So any business that you're actively working, you're putting in the many hours, this works for you. So you could take your active income tax bill down 78 to 85%. So an example, if you are going to write a check this year to the IRS for $50,000 for your tax bill for 2020's income, that tax bill can potentially be reduced down to $7,500 to $11,000. That is exactly why my trust is currently being set up. I am not going into 2021 having to pay a large tax bill anymore. So we also have an intellectual property trust. So how would you like to defer taxes on any income derived from intellectual property, which includes books, membership sites, coaching and mastermind programs, home study courses, and consulting? So talk to us about that. Now, the beneficial trust that we're talking about, all these expenses can now become trust expenses, which means you can now pay all of these expenses out of your trust checking account. Your home expenses, your mortgage, your cable bill, your pool guy, your cleaning lady, all of that gets paid out of your trust checking account. Your vehicle, car payments, gas and maintenance for your vehicle, medical, contributions, tuition, room and board at college for your kids or yourself, wellness, interest on credit cards, telephone, life insurance premiums, bank and credit card charges, and postage. So all of those expenses become trust expenses, and they're no longer after tax income expenses. Okay. Now, children under 21, you can pay for their food and fashion, but if you're over 21, the trust cannot pay for any personal food, personal fun, or personal fashion. But children under 21, it can. Anybody that's disabled in your family, it can take care of food and fashion also. So initially, you sell all of your assets to your trust. You decide what you want to sell. You don't have to do all. It's not an all or nothing option here. You decide what you want protected in your trust. So in doing so, you're going to create a demand note. The trust now owes you money. So each year you can have the trust pay you a portion of the funds owed to you by the trust. So there will be a small interest rate that the trust owes you. So a very small portion of those funds will be taxable. So let's go over that. So right now, you're allowed $12,400 per person to be exempted on income taxes. So that means for a married couple, the first $24,800 pulled from your trust checking account for food, fashion, and fun are not taxable. But if, let's say, you need some more money, you could go to your trust checking account and pull out $30,000 more that year, but count it against the demand note. So you have $54,800 to be used for food, fashion, or fun with a very tiny tax consequence. And then let's say you need a little bit more in the same year, you could pull additional $19,750 out and keep yourself at the 10% bracket. You can pull out as much money as you want to pull out. You're going to get into higher tax bracket the more you pull. But think about this. If your trust checking account is paying all your expenses, how much money do you really need for food, fashion, and fun? So think about that when you're determining how you're going to pay for your expenses. So Nelson Rockefeller says it the best: the secret to success is to own nothing but control everything. So the timing and process for a trust is to contact Scott or myself for a consultation. In some cases, we include a retired attorney to answer any legal questions. And we also have a retired financial person to answer any legal questions that you have. If you're ready to move forward, the documents will be drawn by the legal team and the EIN number will be established for the trust. If possible, set up your trust before you list any property for sale. If your property is already under contract, that contract needs to be canceled and a new one needs to be created with your trust name as the seller. You cannot do this simply by an addendum. You have to cancel the existing contract and put in a new one. And it's pretty simple. You just let your buyer know that you're putting the property in the trust for estate planning purposes. Okay. So remember, you don't have to be selling a property to put your property in the trust. You do it way in advance is the preferable way to do it. So that way, when you do decide to sell, you're ready to go. So the pricing for the trust typically ranges from the $49,000 for a beneficial trust. So a beneficial trust takes care of the passive income, your rental income, and business income, any passive income. Okay. So, and it gives you the asset protection and lowers the tax bill and gets rid of the capital gains taxes. That's 49,000. If you have the active income, then you need the beneficial trust with the business trust that takes care of passive and income tax and active income. That's 89,000. And the business, if you have partners, a business trust with two beneficial trusts is what we suggest. That's $120,000. All of these programs include the first year's prepared tax return and 1 year consultations for any questions that you have. Now, if you're a person that has tons of properties to convey to your trust, there could be additional conveyance documents, fees to take care of that. All right, so let's recap this trust because this is so exciting to me. So the benefits of this trust: does it eliminate federal capital gains taxes? Yes. Does it defer income taxes on your passive income, your rental income? And that, yes, it's going in perpetuity. No income taxes in perpetuity. Does it avoid lawsuits? Yes, it gives you that ironclad asset protection. Does it avoid judgments and liens that can reach your business assets? Yes. Does it avoid judgments and liens that can reach your personal assets? Yes. Does it avoid probate upon death? Absolutely. Does it avoid gift tax and estate tax? Yes. It ensures that the transfer of your assets get to your beneficiaries and multi-general wealth accumulation. Look how much money you're not going to have to pay in taxes. You're going to leave this to your beneficiaries. This is amazing. And it avoids annual fees. So you're going to pay your one-time fee. Even if you want to change trustees and beneficiaries, you can do it. There's no additional cost. They show you how to do it. So it eliminates federal capital gains taxes without doing a 1031 exchange. But in some sophisticated living trust, you may have some asset protection, but it's not going to help you with capital gains taxes and that. So you definitely want to take a look at this trust. And even if your estate is worth over $11.58 million, no gift tax or estate tax will be owed by your heirs. So this is mine and Scott's information. If you want to reach Scott, it's Scott at deferthegainstax.com. His calendar is go.oneshub.com/defer tax. And my calendar is go.oneshub.com/no gains tax. Our website here, Defer the Gains Tax, has videos, it has reading material, it has everything you need on all of our strategies. So we ask you to go to our website, take a look at the videos we have, or if you want to send our information to anybody else to show them. We many times need to talk to your tax person so we can explain to them what we're trying to do so they can help guide you to get this done. So I'm going to stop